you're very welcome to our April edition of Practice News. As ever, a packed edition in the next couple of hours. We go at speed, we try to cover through so many topics. So to begin, I'm going to formally just give you some of the headlines that we have coming and give you just a little bit of a feel for the topics we're actually going to cover here this morning. The first thing here is with relation to the Corporate Enforcement Authority. I'm delighted to be joined here by Fallon Judge, who is Director of Civil Enforcement with the Corporate Enforcement Authority. And Fallon, after 11 o'clock or so, along with my colleague Lillian Halpin, is going to talk through just the current work and current role of the CEA. It's a rapidly evolving role, and particularly the impacts of the work on small practices, small accountants, and also with relation to your clients. So really looking forward to that presentation. It'll be about 20-25 minutes or so. As part of that, we're going to touch upon as well the new general scheme for the Companies Bill 24. Companies Act 2014, hard to imagine it's 10 years old now. And this scheme, you might have heard, was published by the Department of Enterprise back just before St. Patrick's Day. And a lot in it. It is just generally a time for a refresh for the Companies Act. A lot of it will concern new enhanced powers for the CEA, but also as well, and I'm sure anybody here today who is an auditor here and a small practice will be delighted to hear, and we mentioned it previously last year, that the change in the rules of loss of audit exemption for late filing. So Lillian will be getting into a little bit more detail on that, but that is a welcome measure, and hopefully we're going to see movements in that coming into legislation later in 2024. Also, as I mentioned earlier, we're going to actually be joined for recording by Damian Cooper, my colleague Conal as well, to talk about the current investment markets. Delighted to have Damian and Acuvest as our sponsors for the last couple of years here. And great to have his insights into the current investment markets, but he's particularly as well going to talk about pension auto-enrollment and also a topic, decision theory. He's better at explaining all about that than me. So really looking forward to that presentation. That'll be before 11 o'clock or so. Hopefully most of you as well would have received an email earlier this week with our latest edition of Practice Matters. And obviously we take some of the stories from Practice Matters and talk to you here today in the webinar in a little bit more detail on those. Our lead story from Practice Matters is by my colleague Maria Maloney here in Practice Consulting, and it's about buying or selling a practice. And I'm just going to give you some points to consider in that, and then a reference for you back to the actual article itself. Delighted as well that we're going to have our usual tax updates, both this time recorded, firstly from Gerald O'Sullivan, our tax manager for the Republic of Ireland in the Institute, and also by Leoncha Doran, our UK tax lead. Gerald will be up after myself at about 20:10, and Leoncha later in the webinar. And I'll also give you a couple of what I've picked as the key news stories for you in the practice updates around, the final amendments have been agreed for FRS 102 and 105, and also the increases to company sizes have been heralded by the UK government. We've had matching announcements from a European level about 6 months ago. So I'll give you the full detail on that. They're quite bold moves. And there's also thrown in a new auditing standard, ISA 505, for the Republic of Ireland. So I'll give you a quick update on that. Now, hopefully, Lillian, you can see that my slides are moving forward here, that I'm actually A-OK on that. Hopefully that's okay.
Yeah, that's moving forward now, Jeremy. Yeah.
Brilliant, brilliant. Well, just to give you a quick update on who's joining us, I know you'd be very familiar with myself and Conal here, most of you from the Practice Consulting team. Conal is normally, as I say, along with us, but unfortunately today he's not able to join us live, but he will be here for a recorded talk with Damian on investments. I'm delighted, as I said, to be joined by my colleague Lillian Halpin. And Lillian, I'm sure, is a familiar face to many of you from webinars by the professional accounting team, but also has been a past attendee here on Practice News. Lillian is actually a qualified solicitor, and she has a vast amount of experience in relation to the regulatory aspects of accountancy. She also has worked in accountancy practices before, and she's been a technical manager here with Chartered Accountants Ireland since 2021. So Lillian, great to have you on board here for the webinar. I know you guys and most of you here today as well, if you've attended past webinars, of course, are familiar, as I mentioned, with Gerald O'Sullivan. Normally joins us live from Cork, but the recording today, he's actually representing our members in a meeting with the Department of Finance. So that's where Gerald is here today. And he'll have his 20 minutes or so talk on the latest updates. And if you have any questions from those, you can, of course, contact Gerald afterwards. And Leoncha as well will be giving the UK tax updates towards the end of the webinar at about 11 to maybe 11:35, 11:40. So I am especially delighted to be joined here this morning, along with Lillian, by Fallon Judge. And Fallon, as I mentioned previously, is the Director of Civil Enforcement with the Corporate Enforcement Authority. Fallon's going to talk to us about the vital role of the Corporate Enforcement Authority. Just to give you a little bit of background, Fallon is a fellow accountant as well, has a vast amount of experience even prior to joining what would have been the ODC in 2018. She would have worked for many years in mid-size accountancy practices, particularly in the insolvency area. She has also worked as a forensic accountant in the ODC, firstly, up until taking on her present role in 2022 as the Director of Civil Enforcement. So a lot of change. So really looking forward to Fallon's talk, as I mentioned, at about 11:10. And also as well, of course, we're delighted to have Damian joining us again, or join us virtually, we'll call it here, on the with relation to investments. And great to have the continued support from Damian and the team at Acuvest as well as our webinar sponsors. For those of you who don't know Damian, he is a fellow of the Institute here of Chartered Accountants Ireland, and he is the head of investments and private clients with Acuvest. Acuvest would be one of Ireland's leading investment advisors based here in Dublin. Just that's all about us and who's going to be talking to you here today. Just to give you a quick run through of who you guys are, and this is just more, I suppose it's difficult, but in the old days we'd all be inside in the room, you get to look around, see the ages of people who's here. As the show name would actually represent, Practice News is very popular amongst small practitioners. It's great to have your support. Over 550 bookings here today. I see 250 actual confirmed plus participants at the moment, but that could be a lot more depending on how many are in rooms actually listening to us. We also have seen a sizable amount of people coming from or registered with us that are still in business, about 20%. While it's a practice focused webinar, I know it'll be relevant to you as well, many of the technical updates and so on. So you're very, very welcome. Our locations are people mostly here from the island of Ireland. You can see from the map there, it's fair to say we have bookings from every county on the island of Ireland here today. So you're very welcome. We have from overseas as well, from Britain, from Europe, and I think as far away as Australia. That's just a little bit more about the demographics. Now, our timetable, I've given you a very quick overview on that previously. After my introductions here, I'm going to give you those 3 news stories about FRS 102, 105, and so on. Then going to go into the recording of the ROI tax update with Gerard at about 10:20. Then we're actually going to have a small piece for me about buying or selling a practice. And then we're going to click into our investments updates with Cornel and Damian. That should bring us, and these are all approximate timings, to our piece with Fallon and with Lillian about the Corporate Enforcement Authority and that new general scheme to update the Companies Act 2014. That'll probably be, might be a few minutes later than this year, probably about 11:10. That'll run us through to maybe 25 to 12 or so with the UK tax updates for Leontia. We will have questions as well and closing. What we're going to say on the questions is, like ever, if there are questions as they come in, if I can answer them, we will try to answer them. If there are particular questions that might be better to have a consultation one-on-one with a member of the practice consultant team or another member of the institute, I'll say that and you can contact us afterwards. And of course, timing could be a constraint for us as well, but we do welcome questions through the Q&A or the chat function. So please don't be shy. Don't forget, if you can't make all of this webinar here this morning, there will be a recording. We'll be sending out, we've sent out the slides already to you. Chris will be dropping them into the actual chat function as well. I think he may already have done that. And then basically, we will actually be sending out all the slide decks by early next week, and you'll be able to catch a free recording of this session as well on YouTube. This is, of course, just always for every presentation our disclaimer, particularly important this morning. I have in this and in the PDF you have, we give links to everything from the new General Scheme of Companies Bills, new FRS 102 and 105 amendments. Of course, we try to condense and give an overview in a couple of minutes in some very important areas. We have more detailed webinars coming up, which is for more the detail on the auditing and financial reporting. But if you ever have your own particular situation, of course, refer to applicable company law legislation and apply that. Simply something thinking that Jeremy said something that applied and covered off the scenario in a webinar won't suffice, unfortunately, in the future. So that's all the introductions. As I mentioned, if you were on a little bit earlier with us, we have the latest edition of Practice Matters was sent by email to everybody who's registered for our email updates last Wednesday morning by my colleague Maria Maloney, who prepared this edition for April 2024. You can download it if you haven't already by clicking the link on the PDF that you hopefully should have at this stage. It'll give you this and the past issues. And again, like everything, it's a must-read bulletin for anyone in practice, I think, covering, yes, we're covering about buying and selling your practice as our lead story, but tax, professional standards, updates, it really is vital. So please do avail of it. And I know in the old days, a lot of people would even print it out and have it there as a reference point. And I think that's a great way of going about things as well. I'm going to give you a couple of news stories here that are going to come from Practice Matters. So the first one I'm going to have here for you relates to the final amendments that were published just before Easter. I think it was on the 27th of March to FRS 102 and 105 by the FRC. And I'm sure many of you have attended past webinars over the last year, 18 months with ourselves, and we've been giving you updates as to what the state of play is on what is now the second periodic review of FRS 102 and 105. FRS 102, hard to imagine, it is approximately 10 years now in place since 2014, early 2015. And every 5 years, the FRC does this periodic review. This one has been going on since 2021, and the FRC gets stakeholder feedback from accountancy bodies, practices right across the UK and Ireland. And not just now, they have the final amendments issued, and you can get that live link in the PDF there back to updates and amendments, what feedback they received, and so on as well. And this will now conclude the periodic review of FRS 100 to 105, the full UK and Irish GAAP. Now, I know we would previously have talked about what would have been the first set of proposed amendments that were put out in FRED 82, which was at the end of 22, early 23, on past practice news webinars and financial reporting webinars. The good news is there has been nothing new added in these final amendments, but there was feedback from ourselves and from other stakeholders as well that there needed to be better simplifications, but there also needed to be better guidance given with relation to the two key areas that have been proposed for changes, which are leases and revenue recognition. Now, typically in an update of FRS 102 and 105, the FRC would look at what has changed in matching requirements in international financial reporting, or they may look at what areas are working well, but maybe areas that have been pinpointed that they need to update in FRS 102 and 105. The two big changes coming here around lease accounting and revenue recognition are coming in just to match in with international financial reporting updates in the last number of years since 2018, 2019, and the first periodic review. Now, the first and the biggest change, I think, for any small practice and your clients will be that going forward with the full implementation of these requirements from 2026 or earlier, if you wish to, is Section 20 of leases will now be based on the on-balance sheet accounting model, which is consistent with IFRS 16 and leases. Now, this, of course, is going to have a lot of impact for lessees, and particularly lessees that may have so far been using operating leases and not keeping them on balance sheet for maybe large assets such as buildings, cars, machinery. All such large assets now are going to be actually mandatory to include them on the balance sheet and matching liabilities. So that could push some companies up a threshold from small to medium, bring them into the audit requirements, or even bigger, bring them into CSRD reporting here in the Republic of Ireland. Now, what's happened since FRED 82 and for these latest amendments is the FRC has taken on board feedback here that it could potentially impact some companies and some accountants a lot. And they have tried to give more exemptions, particularly around what assets qualify still for low value items and short-term leases, what assets qualify to not be under this requirement for FRS 102. They've actually even included a list of what is not low value in their IDs, such as cars, buses, and so on. So that's the key pin where they've tried to give better guidance here. Now, the good news is this requirement will come in for FRS 102, but it won't come in for FRS 105. It isn't proposed. So the present operating and financing and on-balance sheet leases, the two different models will still apply for FRS 105 going forward. So that's the big one there. Now, the next one I'm going to click to here is just with relation to the second area of change, and that's Section 23 revenue. Again, we've talked about this in the past. It was in FRED 82, where the five-step model of revenue recognition that is in IFRS 15 is going to be brought into play here, both in FRS 102 and in 105. Now, for most SMEs who simply sell goods or sell services, this isn't going to be a particular big issue. But for some that might have a combination in their sales of goods, maybe warranties, provisions, different things, it can make life a little bit more complicated, and they will need to go in depth and you as auditors or accountants in there as their advisors as well to work through this model to ensure that revenue has been recognised correctly in the financial statements. So it's, I think, going to be less of an issue than the lease accounting for small practices and small businesses, but one still to be aware of. Now, as well, there were some other changes. The biggest one here that's going to come into play is that there will be a new paragraph 3.8a in FRS 102 on enhanced going concern disclosure requirements. And this is about basically stating that there will be a required statement that the directors are adopting, yes, the going concern requirements, but also the basis of adopting any judgments they have used to make this adoption of the going concern standard and preparing the financial statements. So a more detailed, positive statement in this area. Now, there are some other changes. I won't go into depth here on them, but you can read them at the previous link in the amendments. Now, the proposed effective date for the vast majority of these changes is going to be for accounting periods beginning beginning on or after 1 January 2026. So you can see we have 20 months of a running period here. And I think that was definitely going to be good for practices as they help clients that are going to be impacted as leasers for the lease accounting changes. You can early adopt, but the one thing with early adopting is you have to bring all the changes proposed in simultaneously. And there is one or two little areas where you can be applicable from 1 January 2025. But you'll learn more about that if you want to come along to our Financial Reporting Essentials webinar on the 8th of May. Now, the good news as well is we have asked as an institute in our feedback, we wanted to see more detailed guidance and even worked examples as to how the FRC see these changes being implemented in real life. So the FRC is committed that over the coming months as well, that it will bring out staff help sheets in this area. So hopefully that'll be useful to everyone. Now, my next news story here relates to announced changes by the UK government on UK company size thresholds. And as I said, follow on from matching announcements on the EU level back last autumn. Those proposed new changes are in that graphic you can see there. And as I mentioned, with relation to financial reporting, FRS 102 and so on, company size thresholds, of course, are vital. As we know, we have 4 existing company size thresholds: micro, small, medium, and large, that come for both the UK and Ireland from EU accounting directives pre-Brexit, pre-2020. Now, since then, the UK has kept to the same limits, of course, in sterling, as would have been set out in the last EU accounting directive in this area back in 2013. But that's a long time ago. Inflation has impacted, and the UK government has decided after completing its non-financial reporting review that it too is going to increase its company size thresholds, but not by the European limit that has been set of an increase of 25% to match inflation over the last 10 years. They're going to future-proof forward and actually increase the limits by 50% to give a threshold for a number of years where changes won't be needed, and that it'll match what could be a continuing period of inflation above the norm in the coming years as well. If you want to see the exact changes that's proposed under this and the new thresholds, you'll see them in the previous slide there. The whole idea here is to help small business to actually have potentially that they're not going to be overburdened by reporting requirements because inflation had creeped up here, but also just to cut in costs. Figures I've seen, about 130,000 UK businesses, be it small, be it micro companies, will benefit from this. So it's a lot of companies that will benefit with these changes. Now, legislation has to go in front of the UK Parliament during the summer months, and the intended date is that for these new changes will be in place for financial year starting on or after 1 October 24. Now, as I mentioned in past Practice News webinars, there has been changes proposed at a European level and indeed approved by the European Commission. They all have to be brought in by each individual country. And here in the Republic of Ireland, these changes were 25% increase to match inflation for company size thresholds. That legislation hasn't been enacted yet, but it's likely, I imagine, to see movement in this area before the summer recess, before the end of June. But we in the Institute will keep you posted on that as it goes forward. My final news item here is with relation to auditing. So one for the auditors, it's ISA 505 that has been a revised version issued just in March 24 by IASA. And with relation to this, the key changes here is that it comes from the, normally IASA would take its moves from what would have happened with the FRC for UK standards, and there was an updated UK standard issued in October 23. And if I was to pick one key change here, it relates to the prohibition under this new ISA of negative external confirmations. So it's not possible, and I hadn't seen it in practice, but maybe it was happening where people were sending out debtor confirmations, bank confirmations, and asking the counterparty to only respond if they didn't agree with what was stated on the confirmation. No, now you are only allowed to send out positive confirmations. Those negative confirmations are outlawed, and they would not be seen as giving positive evidence in this regard. Now, this new requirement is going to be in place for financial statements periods beginning on or after 15 December 2024. So essentially December 25 year ends. You can early adopt, and I'm sure many will in this area. I think it's a good practice to do it. If you want to learn more about this and any other changes in auditing, we have our spring auditing update coming up in about 2 weeks' time on Thursday, the 25th of April. So hopefully some of you that are auditors can join us on that webinar. Now, that is me, thankfully, you will say, all finished with those news updates. So hopefully you found them useful. Chris, I know you're sitting there in the background. I think you have the video ready for Garode. 21 minutes, you told me. So hopefully you can still hear me and that it's all good to go.
Hello everyone. So today we will be doing the ROI tax update as a pre-recorded video. So I'm sure that has been announced by now by Jeremy and Conal. So I'm just here to give a quick update on some matters I think will be relevant and some which I have mentioned on several presentations now at this stage, and certainly for viewers who've been coming along to the last number of webinars, you'd be familiar with some of these topics, but again, I think it's always worth just picking out those topics of most relevance to everyone. So sometimes it will be important to bring out some minority sports, but I think here there are, as you can see, the ERR and Carson continue to be on the agenda, and just want to provide an update on where some of those things are at. But first, I want to talk about VAT registration. So VAT, by its very nature, tends to be a bit of a minority sport, but we all encounter VAT either as in a private capacity when we're looking to buy a coffee, which may or may not go up in the coming weeks or months based on how government responds to the calls for VAT. For VAT changes on our cup of coffee, as you might see in the recent push by the industry for a 9% VAT rate, or the continuation of it. With VAT at businesses, once you cross certain thresholds, you're going to have to register for VAT, and often before you actually cross any thresholds, you may make the decision to register for VAT to avail of some of the benefits of VAT registration. With VAT registration, there's always the increased compliance costs and also the increased risk of revenue intervention, because you're paying a tax, and it's of all the taxes, it's one of the most important to get right, because as a VAT collector, as a business that's collecting VAT, you're collecting that VAT in a fiduciary capacity. So it's a very, very important tax to get right off the get-go. Just want to mention here something that has come up into the context of VAT registrations at the TALC Indirect Taxes Subcommittee. So this is one of the TALC groups that meets to discuss matters, as it says, pertaining to indirect taxes, principally VAT. Excise comes up a bit as well, but it's principally VAT that we're looking at. So at the recent meeting, a group from the registrations unit in revenue came in to give a talk, and they gave a very, very helpful presentation on some of the issues that they tend to encounter when they're processing VAT registration applications. I've included a link to that presentation in the notes in the slide today, and so that's up on our website, and I encourage you to go in and take a look at that those slides, right? And I don't propose going through that presentation in detail today. What I am suggesting off the bat, I'm going to go through some of it now just to give you a flavor of some of the things that are in that. But if there is an appetite for a bit more of a deep dive on VAT registration, just say maybe at the next Practice News webinar, we could do maybe instead of the general tax update, perhaps you could consider we could consider offering a quick work a quick whistle stop tour on VAT registrations, you can link us in the notes or email us below at Tax Chartered Accountants, or indeed just pop into the chat and I'll pick it up later on when I'm catching up with the guys here. But just some of the things I want to mention when it comes to disallowed VAT applications. So again, the reason I want to talk about VAT is because it crosses the spectrum of business. We'll all encounter VAT at some point, as I said. And typically as accountants, whether we are working in an industry, whether we're out in practice, whatever level we're working at, we will come across VAT. And particularly if you're at that threshold where you might be at a high level familiar that, oh, look, it's once I cross the threshold, I should register, or indeed, if I'm thinking of carrying or commencing a certain activity, sure, I should just be able to get VAT registration. It's not as simple as that, and that's the message Revenue have come back with. And I guess the great thing about having this discussion with Revenue is that I suppose they've been very forthcoming in I suppose what are issues and what they require. And I suppose the thing of, as advisors, the best thing we can do is just to be a step ahead of that now that we have the information. So as I say, that presentation, it contains a lot of the detail, but some of the reasons, right, why a VAT application would be disallowed, I suppose first and foremost, in Revenue's view, the person is just not an accountable person. And that's fundamental to VAT registration. So I don't propose going to deep dive into accountability for VAT purposes, but I suppose that's typically what they see, that someone just is not an accountable person. They might also see that there's no taxable activity. So in theory, you may be a person with a business, but you might not actually be doing any taxable activity. So there's no actual VATable activity. The activity itself is exempt. So naturally, if you're exempt from VAT, there's no requirement to register. So the benefit of VAT exemption is you don't charge VAT if you do have any sort of sales, but you don't get to reclaim VAT on any purchases and acquisitions. So the other benefit, of course, is reduced compliance costs, reduced risk, of course, for anyone in that exempt space. In terms of a common scenario is when when a liquidator, receiver, or mortgagee is taking possession of assets, they're not linked to assets, so they can't actually get VAT registration. So you'll often see this in the context. This can arise, say, if a liquidator takes possession of some business or some property type business. They'll need to get. They may often need to get VAT registration to carry on the trade, but the liquidator being a separate entity to the previous business owners. There is another group of VAT registrations, which are intention to trade applications. And this is, I suppose, where a person is about to come into trade, and say before they can, before the business can make a sale or complete a contract, they have to have a VAT number. And you can see that in certain commercial agreements. It is more of a challenge to get a VAT registration on this basis of intention to trade. Some of the details Revenue give are, to be regarded as an accountable person, you must have an imminent, the commencement of trade must be imminent. You must be able to provide substantive, objective evidence of the trade, and you must demonstrate the capacity to trade. So you must demonstrate exactly that you must be able to actually do what you're saying you're going to do. Revenue do take a holistic view of documentary evidence. They will take individual items into account. No one item of evidence will deem an applicant accountable, but each bit can help to paint a picture. So they look at like resources in place, both kind of financial resources, human resources, business plans, bank accounts, place of business, etc. And some common issues in disallowed applications include a CRO registration with mainly non-resident directors, or just a single Irish resident director, no proper place of establishment, using the agent's address, PO box, or virtual serviced office as a business address, no evidence of contracts or customers, inability to produce a valid invoice, no employees or agent director listed for the application purposes. So that's just a certain flavor of things there. What I would say is have a good look at those slides. If as I say, there's a strong appetite for a kind of slightly deeper dive, a bit more detail on VAT registrations, that's something we can look at. I can chat to the guys here about. But just want to give you a quick flavor there of some of the issues that we're discussing. Again, you can look at the slides for a bit more detail. The link is there, so I do highly encourage you to just take a look at them and see if they're relevant. Even if, again, I appreciate VAT is a minority sport, and it's not one we'll talk about often on Practice News here. But as I say, we all encounter VAT, and the danger with VAT is actually thinking you know something, but not realizing how complicated it is. And again, as a tax specialist, that's one where I always have to step back and kind of always start from first principles and think, what could I be missing here? Because there's a lot of nuance to VAT. It is within tax, it's its own specialism in itself, right? So again, as accountants, who people will come to us assuming we sort of know about all these different things. I think it was certainly under registration, it's sort of one we think, well, look, even if I don't know about VAT, surely I can bang an old registration through. In the sense, look, it's sure if I can register a company for CT or register a client for income tax, that's a bit more different, it's a bit more complicated. And simply the reason being, there's been a lot more VAT registration applications following the Britain's exit from the EU. And also, just with VAT, there is a gap. The VAT gap is, I suppose, the difference in between what should be collected and what is, and that's in the billions at the moment. So across Europe. So there is scrutiny of VAT applications, because with VAT fraud, what can happen is if someone gets a VAT registration and starts commencing some type of VAT fraud, they can simply walk away with cash very quickly by just cancelling a registration, moving on, and just, it can happen very fast. And VAT fraud is very hard to remedy by all accounts when it does happen. So the best way to prevent that is to make sure that VAT registrations are legitimate from the get-go. So next, just want to talk about enhanced reporting requirements. So I just want to send a link to the guidelines again. I suppose we're continuing to mention ERR because I suppose it is live now, and it's been live since the 1st of January. And I guess, if you're making payments that are within the list of covered benefits, then you have to be making the ERR return. As mentioned in the last call, the service for compliance approach will run to end of June. So I suppose the idea is that once you make the best effort to comply, revenue will be running that service for compliance, which I suppose means they won't be applying interest penalties and these kind of things for that first few months. The revenue released a press release just in the middle of February there with some latest statistics on it. So the submission and with statistics for January. So just to briefly discuss them, submissions made to revenue during January relate to over 702,000 payments and benefits that were provided to 226,800 individual employees and directors. So the value of these payments and benefits amounts to almost 86 million euro. And this has been broken down there's 14,000 remote working daily allowance payments valued at almost 700,000 euro, 32,000 qualifying incentives under the small benefit exemption. They're valued at 19.3 million euro, and 656,000 non-taxable travel and sub payments valued at 65.9 million euro. So as expected, travel and sub coming in there as the biggest chunk of payments. I'm sure that'll be a surprise to no one. The level of payments is quite high, as you can see. I'd expect that to go up and up over the next few months as people do get to grips. Look, I'm sure there's many companies that not many, but there's always going to be a few as a new reporting requirement kicks off that maybe just aren't quite ready, or maybe haven't reported. Look, that's probably the nature of the beast here. But I suppose it's imperative that your reporting, if you've started your reporting, that it's accurate, that it continues to be accurate, and that if there are any issues, that you're I suppose either bringing them to revenue's attention or bringing it to our attention, and we can feed back into revenue. Again, just have links below there to the email addresses you can reach us on. Look, I have a link to that press release also. I think just worth being aware of the value of payments at play at the moment. I suppose the the guidelines there are helpful. They will provide some information on your, we've talked about it quite a bit at Practice News over the last number of months at this stage, probably over a year now, since it first kind of came into our orbit. But as I say, it's up and running now, and just important that your company has the right procedures in place to make sure you're reporting under this new requirement. Want to mention quickly, so just conscious of time as well here, the Carson guidance. So I would have mentioned the Carson decision on the last Practice News, and I would have included a link to it. And at that, then and again now, I encourage you then, and I encourage you now to read that judgment. It is so. The judgment itself is arguably fact specific, related to Domino's pizza drivers who were initially who arranged to be working under independent contracts with the Domino's pizza company Carshan up in the Midlands there, but Revenue took a case to the appeals commissioner saying these are actually employees, and ultimately that went through the High Court, the Court of Appeal, into the Supreme Court, with the Supreme Court overturning a Court of Appeal who themselves overturned the High Court, the Supreme Court finding that the drivers were in fact employees of Domino's. They were looking at, I suppose, the overall fact pattern suggested that these were employees, that had all the hallmarks of employment. The case is arguably fact specific, but we have been provided with guidance through the TALC process, right? So this is just through TALC. This is part of our advocacy work, a big part of it. We can, I suppose, Revenue share draft guidance, and we can discuss that with them and just consider if there's anything in it, I suppose, that I suppose we might have a slightly different view on. And typically, look, I suppose the final say would always be with Revenue. We can just give our 2 cents on it, but that is working its way through the TALC process at the moment. And again, this is evidence in the minutes. It is part of the process. But as you can understand, it's not appropriate to share that outside of the TALC process, just for obvious reasons. But we are expecting the guidance to be finalized in the coming months. What I would say for now is to familiarize yourself with the Supreme Court decision. There are potentially there could potentially be some changes from the Supreme Court decision. It remains to be seen, I suppose, the extent of that. As I say, there is a one line of thought which says the Supreme Court decision is fact specific, but similarly, I suppose when you're talking about employment status of workers, it's just important to have the ducks in a row, particularly at those grey areas. So just to mention that judgment is one I'd say if you are working in this area, it's an area. If you're involved in providing tax advice, or indeed if you're in one of those industries that's similar to Carshan or in any way analogous, I would familiarize yourself with that judgment. It's quite a lengthy judgment. It's by no means easy reading, but it's important reading for anyone operating in this space, particularly in light of the guidance that is coming out in the coming weeks and months. And again, we'll update you on that guidance through Tax News and the usual channels in due course. So Pillar 2 guidance, just want to mention Pillar 2 guidance is due out in the coming weeks as well. So this is certainly a minority sport, but it's relates to some of the biggest taxpayers in the country on the corporate side. So just if anyone is on the call working in that space or has clients potentially in scope, just to know that guidance is coming. So we won't go any deeper into that. If anyone that's involved in Pillar 2 will be well aware of the general work that's been done in that, but we have been actively engaged with the Department of Finance and Revenue just in sort of ironing out the kinks of the legislation. It's landmark legislation, so naturally complicated, and it's been a very proactive process as well between the different representative bodies, of which we are one, of course. Then just a general update on our recent advocacy work. So again, we continue to represent all your interests at the TALC process. So that's the Tax Administration Liaison Committee, and we work at main TALC. There's a direct and capital taxes forum, indirect taxes forum looking at collections, audit, and the BEPS process as well, which is where Pillar 2 gets discussed, and other matters. The reason I'm not at today's meeting or live is I am attending the Department of Finance Business Tax Stakeholder Forum. So this will be the third time this group has met. They met twice last year, and this group is really focusing on business tax measures. It's more of a policy level than an administration level, and it so far proved to be a very fruitful initiative from the Department of Finance, where it's not necessarily like calc where you have this deep engagement and a bit of back and forth, but it's great to see what the Department of Finance are doing on an ongoing basis, and I suppose the agenda that they're working toward in the coming weeks, months, and years ahead. So again, we'll have an update on that at the next meeting, because it is generally of interest to many people. I think it's just a very interesting forum to be part of. There's an upcoming meeting where with Indicon, where we will be discussing the recent share-based remuneration consultation and our response to that. So share-based remuneration is obviously for everyone working across the practice spectrum. It's one that I suppose has been very beneficial for people working in bigger companies, but it's not proved to be as useful for people in smaller and startup type companies. So that's really where our focus will be on behalf of members, and that has come out in our share-based remuneration response, which I shared on the slides for the last meeting. And again, you can find all this in the representation section of our website. And we are just finalizing this year's pre-budget submission, so we're aiming to actually get that out a bit earlier this year, just given that I think the general call from the Department of Finance and others has been the earlier that they receive our suggestions, the better. So we'll be focusing this year. Obviously, housing is going to be a big. It remains high on the agenda for obvious reasons. We still have a ways to go, and I just reading this morning that it looks like the government may increase their targets to 50,000 homes a year, which is a bit more realistic from the 33,000 it currently is, I think, because there are calls that perhaps it should be even higher than that again, but we'll see. It remains to be seen there what the government's target is, but certainly a lot of houses are needed. Still, childcare is. We didn't have a housing crisis. Childcare would be obviously the next. Childcare would be the next most pressing issue. Obviously for young families, anyone on the call with young kids, they'll be aware of the high costs of childcare in the country at the moment, and the capacity and issues also. And then we'll be focusing on measures to improve, I suppose, the cost of doing business, particularly for SMEs, and the usual bits around sustainability and a handful of other points around auto enrollment and VAT. So, but the main focus this year is housing, childcare, and Indigenous business. So SMEs, Indigenous business, I think, are synonymous at this stage. So again, keep an eye out for that. We will have an update again at the next practice news. But look, conscious of time. So for now, that is it for me, and I hope to see you at the next meeting. Thank you.
Road, thank you very, very much for that very comprehensive update again. Yes, indeed, that is a very complex area. I know we had a few questions that came in, and hopefully most people have seen that we shared the actual PDF of the slide that Garode had. Garode was very good to prepare that recording later yesterday afternoon, so just after we sent out the initial slide deck to you. And so you have that if you want to get the PDF, and actually then to click through to all the different links that he had there to various revenue guidance. I'd always say to everybody here as well, I'm sure most of you do, but to ensure that you do get your tax news on a Monday, I find it a great resource for UK, Ireland and international tax news. Past issues are up on the website as well. And indeed, it's something now that's shared via LinkedIn as well. So if you're a LinkedIn user, you can get the update right to your account and you can go through it, and it's so easy to use. So thanks again to Garode and to all of the tax team, Jansha and Krona and everybody else, and right up to Brian and Grania and everybody else for their help and assistance, and particularly Garode this morning for preparing that recording. And I hope his meeting with the Department of Finance goes well actually today. Now, clicking onwards, I am going to try to share my screen again, but this may or may not work, as I say, because it's only going to be for one slide anyway, with relation to my next slide. But if it does, great. If it doesn't, it doesn't. As I say to you, I'm going to try to go slideshow, and I'm going to go from beginning, and I am going to click ahead. So my next topic I'm going to talk about, hopefully you can see the slide here that's referring to the link to Practice Matters. Chris or Lillian, you might say, tell me if you can see the slide or not, but not to worry either way.
Yeah.
Hopefully, yep, you can see
that
it.
there, Jeremy. Yeah, thanks. Yeah.
Brilliant. Thanks, Lillian. Basically, the Practice Matters, as I mentioned, our lead article has been prepared by my colleague, Maria Maloney. Some of you, I'm sure, are familiar with Maria. She began working with us in practice consulting. I know she's been very active in assisting members with queries and so on about a year ago now. And Maria has taken charge of preparing Practice Matters, something we've been having for many, many years. And this is the second in a series of articles this morning that I'm going to refer to. The first one was back in February, where we're talking about the growing trend of private equity investment in the Irish accountancy market. Seems to be nearly every week we're seeing a firm with a new investments from overseas. And of course, it was great. We had Neil Morrison of McInerney Saunders, who would have announced a big deal with Danes Group, a UK group, in January. We had Neil on the actual practice news show back in early February. Of course, if you go to our website, you can get a recording of that, or a YouTube channel as well if you missed that one at the time. But this morning, I'm just going to have a very quick chat with you and give a quick overview of just some things to consider if you're in the situation that you're potentially looking to buy either a whole practice, a block of fees. It could be somebody has come to you who's potentially retiring in your area, in your town, or that you're looking to expand. And organic growth, of course, is one way, but of course that you may be looking to expand and opportunities come your way to buy out somebody who is retiring, or you might be that person who is retiring and who's looking at, what can I do? What tips as I prepare in the next couple of years to ensure succession planning? But if I do have to sell my practice, what steps can I take now to ensure that it's in the best position, that I can get the best price for it? So in the article, Maria has looked at a couple of points, and the first one is to buy a practice or a block of fees, and what are the key things to consider here. Of course, like any transaction that you'll be involved in, any purchase of a company or advising on, some of you here, I'm sure, great experience in corporate finance, doing your due diligence on any practice or block of fees you buy is vital here. Ultimately, for most, you're just buying the goodwill, you're buying the access to a block of fees with this practice and so on. But you're also more than likely, depending on the size of the practice, going to get staff. And staff is such an invaluable resource these days. As we know, holding on to staff is one of the key challenges for any practice, but also getting good qualified staff or good staff that have many years experience and holding on to them. And if you're actually getting a new practice, that can be a great addition, and it can be as strong as addition as sometimes in the client base that you're actually getting. Also as well, there might be other things like obviously buildings or different things that could be something that would be of benefit. Perhaps you might decide that you would acquire a practice for access to a building and sort out your own capacity issues for your own existing office. I suppose some of the things to actually look at here as you are doing your due diligence is, of course, to buy a practice. If you are looking at, look at the client base, look at the age of the client base, of course, look at the size of the fees. How do they match in to your own practice and to your own fee expectations? There isn't a match there, or if the clients are quite old, as can happen with some more senior practitioners, that's an issue that you will, of course, have to build in to potential client retention going forward if you did proceed with the deal, but also at the price and valuation you'll put on those fees. As I mentioned, the existing staff as well as vital. What are the age profiles? Are they likely to stay with the practice going forward? And how would they fit in with your new style? Again, it could be the location of the practice as well. How would you work it going forward? Would you merge together your office and this new office into one? If it's that staff would come back into your own practice, into your existing location from the practice you buy, how will the staff react to that? Are they likely to stay? What work practices do they have in place? They're all points to consider if you're actually doing your due diligence and ultimately doing your deal with a practitioner to buy either a block of fees or to buy a whole practice. Now, again, with relation to selling your practice, of course, you have some points to consider here. I suppose firstly is, how could you make your practice, even from a practice management point of view, more saleable, and that there'll be less complications if you do a deal with somebody. Keeping things and following up on things like WHIP and keeping debtors to a very low level, it does make life a lot easier for valuing your actual fees, and also life potentially with relation to any workout, a sale, and any clawback. WHIP, and particularly the older it is, the older debtors are, yeah, they're harder to actually reclaim and ultimately get paid your full money on them. So that's one thing to be aware of. I suppose as well, even simple things, depending on the age of your building and your office and so on, it can be just maybe have a refresh of the office again, maybe looking at how digitalized your practice is and so on. There are key points as well, and how would it fit with a newer, younger practice if that's the situation you're actually in. We also mention in this article such things as valuing a block of fees, be it the buyer or the seller. I know traditionally we always start from a point of 1 for 1 per turnover, per recurring annual turnover would be the basis valuation, but some would be lower and some can be a lot higher. We've seen in recent deals as well. We go into a little bit more about that, and even the structuring of the payouts usually would be in a stage basis, and how long the existing partners would stay on as well. We do cover a little bit with relation to admitting a new partner, and obviously the funding and the differences you'd have there. Obviously it's a new partner, they're joining in, they're already part of the firm, so client transition, we will say, is a lot less of an issue here. Again, I will leave you to just read that article, read the past article as well in the February 24 edition. And we in the practice consulting team, Maria, Conal and myself, we're always happy to arrange a consultation if needs be with any buyer or seller of a practice. Typically, such consultations can take 45 minutes, an hour or so. But if you are interested in that, please contact us at our practice members email address, and we will try to arrange something with you in that regard. So hopefully you'll find that article very, very useful. Now, without further ado, we're going to move on to our actual next area and presentation, which is with Conal and Damian. And as I mentioned, great to have Damian back on again, and we're going to have a longer talk with Damian today. Now, a recorded talk again. Damian unfortunately cannot, in addition to join us, neither can Conal as well on this occasion. And they're both going to talk to us about, yes, the current investment markets, UK, Irish and international, but also auto enrolment and pensions, and a few more things thrown in as well.
We're delighted to have Damian Cooper on. Damian from Acuvest, our sponsors. Acuvest are a firm of independent investment and pensions professionals. And I know when we were speaking earlier, Damian, that there was a couple of points that you felt you'd like to share with our members. So over to yourself, Damian. There's certainly changes afoot in the pensions world in Ireland.
Yeah. So just as we talked earlier, Conal, I think one of the things that the way I think the things I'd like to cover is just maybe to give a quick overview of markets, because I think that the members appreciate that. Just a touch base on that, and then a couple of things that have been in the news recently that I think also might be of interest to the members and their clients, I suppose. And so I'll go into that. And so the market summary. Then we'll have auto enrolment is a topical at the moment, because legislation was published in the last week. And then there's a gentleman by the name of Daniel Kahneman, who was one of the founding fathers of a field of science called behavioral economics, which I'll get into in a minute. He died over the last few weeks, and so looking back on some of the obituaries and things like that reminded me of some of the wisdoms that his research over his lifetime pointed out to all of us, and we've all learned, I suppose, from the world of finance and investments, learned a lot through from behavioral economists and the work that they've done. So in terms of to kick off, just like I suppose the markets, thankfully we've had a very, very strong Q1 in markets. Global stock market is so global economies are showing continued resilience. Labor markets are still strong across Europe and also in the US. And inflation has fallen, so food prices are coming down, and energy prices are coming down, and so so that's a welcome thing for consumers and businesses, I suppose. I mean, inflation hasn't come down to the level that central banks would be targeting just yet, and there are still some uneases in there, and they're watching out to see there are hints that that wage inflation might be a challenge at different stages, given the strong labour markets and wage negotiations, as people are trying to catch up on, I suppose, price increases that happened over the last few years. And so central banks generally are reluctant to cut interest rates too early and then let inflation run riot again. And so they haven't got it quite back under control. But they are looking at, certainly, interest rates do seem to have peaked, and we're looking at cuts this year. So the ECB is expected to cut maybe in June. The Fed keeps backing away from its original intentions. Certainly, the end of the year, the markets were anticipating that there'd be 6 or 7 rate cuts by the Fed this year, maybe as early as March to start with. Now, you have, it looks like certainly not before June, and you have some Fed governors coming in saying that numbers of cuts this year, or maybe 1 or 2, and so that's obviously a lower level of cuts than were expected. But generally, markets are looking good. There's optimism over the prospect of soft landing in the economies. And the potential that is represented by AI is certainly a good thing for markets, and equities are up more than 10% this year.
So
from our perspective,
Damian, so as I understand it, AI is perceived as being something that's going to cause global growth.
It should give the opportunity for efficiencies, for productivity gains. If you can have computers doing some of the stuff that people had to do, and that was maybe repetitive and not that productive, and computers can do that in the background, well, then that's better for companies. It's better for people, because they don't have to waste their time doing stuff that the computer can now do more productively. And so ideally, in an ideal scenario, the computer does more of the work and people have a bit more leisure time, and they still get paid the same amount. Now, whether or not things work out that way, we'll see.
I see sort of 2 different perspectives on AI. One is it's going to cause job cuts, and I mean, even pick the accountancy world. You see different headlines saying this will cause job cuts in the accountancy world, and then you see other headlines saying there are fewer people coming into the global accountancy population. So
yeah, it's hard to know
people
the
aren't
answer.
really joining these things up as much as you might think, but it seems as though AI might actually be coming in and giving us some benefits in that front, even if you take it from the narrow perspective of the accountancy world. But anyway, sorry, I interrupted you there. I mean, it sounds like things aren't as volatile, perhaps, as they might have been.
They haven't been. So Q1 has been good, on top of a good year last year. I suppose the only note of caution that we would say is that markets are priced for positive outcomes at the moment, and there still are a lot of risks out there. If you think about, there's a lot of elections going on this year. We talked about that the last time. This is almost the year of the election, more than half of the world's population having votes. Now, some of those have already happened. Putin surprisingly won the election in Russia, but we have obviously got more contentious elections still to come, and notably, I suppose, the US presidential election later in the year. And then there are geopolitical risks, which, the Middle East, we certainly had escalation in that over the last couple of weeks, which has had impacts on the price of oil. We've got, China, Taiwan seems to have gone a little bit calmer, which is good, even post the elections there. But obviously Europe, there's still ongoing, ongoing war between Russia, in Russia and Ukraine, and the Russians seem to be making some advances, which is not good from a global perspective, certainly not good from a European perspective. And so, we just always have the possibility of these things blowing up into more than markets are expecting. So from our perspective, from an asset allocation perspective, even though things are looking better and the economies look like they might avoid recessions, and we might get that, soft landing in the US, we're not advising people to up their allocation to equities. We're advising them to still hold their full allocation to equities, but to take advantage of yields available, the higher interest rates that are still there, ECB rates of 4%. bond yields in anticipation of rates coming through a little bit, rate cuts coming through a little bit slower. Bond yields are staying higher for a little bit longer. So there are good returns available, 4 to 5 to 6% from different types of government, corporate and high yield bonds. So you can get good returns on your portfolio without having to go all the way into equity markets. And so having a balanced portfolio is still, having a degree of balance in your portfolio is still appropriate. But it's welcome that you can earn some good returns on what would be considered safer assets, which is great.
Absolutely, that's good. And then bringing it closer to home, I know that you were talking there about auto enrollment. I know.
And so auto enrollment over the last couple of weeks, we had
perspective on it.
Over the last couple of weeks, we had legislation that's been, I suppose, in the offing for quite some time, has been approved by Cabinet and has been published. So that'll go to the Oireachtas over the next session. What they're aiming to do at the moment is aiming to have, the almost 800,000 workers in the Irish workforce who are not covered or not members of private or occupational pensions at the moment, to have them enrolled in this auto enrollment scheme by January 2025. Now, whether or not that's is a little bit to be seen, but certainly there are big implications for society, because that 1/3 of the working population that hasn't had private pension before will now start having pensions, albeit slow to start with. But it certainly has an implication also for employers, because they need to think that as soon as Q1 next year, they need to think about these people will now become members of an auto enrollment pension plan if they're not already in one. So what that means for an employer is that they're either going to have higher cost if they've got to make pension contributions for these people that they didn't have to make in the past. And also probably implementation challenges. So if employers aren't running pension schemes, they need to now provide a way that these salary deductions can be processed and handed to this new auto enrollment scheme. Or potentially they may have members, of an existing scheme, and then other people that weren't members of a pension scheme, and you might have to cater for people being members of two different things. So that is two different schemes, and so that's something that they need to think about and maybe plan and say either they're going to start enrolling people now in their existing company scheme, or providing PRSAs for them, or just cater for the fact that they will have to cater for those contributions in likely to be Q1 next year.
Okay, so anybody who, unless all of your employees are in a pension scheme, you're going to have, this is going to impact you.
So everybody between the ages of 23 and 60 who is earning more than 20,000 euros per annum.
Okay, good. And this is in the nature of a defined contribution type arrangement.
Exactly. It is. It's a state-run defined contribution scheme, a bit like they have in the UK. Obviously, the terms and conditions are a little bit different, but most countries in the world have some sort of auto enrollment. Most OECD countries now have some sort of auto enrollment system. So Ireland is a little bit of a laggard, but hopefully that will mean that we'll have an opportunity to learn from mistakes from others and put a good scheme in place.
Absolutely, and it's going to be something that we're going to be looking much more closely at as the year progresses and as the legislation is finalised. Okay, this is very interesting. Now, and I know there's one other matter which you wanted to raise, and it was the recent death of Daniel Kahneman. Is that right?
Yes. So Daniel Kahneman was a psychologist who, I suppose, unusually maybe for a non-economist, was awarded a Nobel Prize for economics in 2002. He was really he died at the age of 90 over the last the last few weeks. And it sort of has reminded people again of his prominence. He was an academic all of his life, obviously being a Nobel Prize winner in the field of. He was a pioneer in the field of behavioral economics, and really what that means is the work and research that he would have done through his life in conjunction with other pioneers in the field was really about the way that people make decisions and how our inherent biases impact on those decisions, and ultimately I suppose how being aware of what we do and why we do it and how we tend to do things, which is maybe not always fully logical because we are emotional beings, how being aware of those things can inform us and help us make better decisions, I suppose. And really, so it's about trying to help people make better financial and life decisions. When I look back on some of the stuff that, you know, some of his workings, you know, there's a few things that jumped out at me, you know, that are big topics that he emphasized at different stages. One is that people are loss averse. So that what that means is that people feel the impact of a loss more than they benefit from the gain, the corresponding gain. So we have an aversion to loss. We have a fear of losses more than we enjoy the gains on the other side. But you know, a little bit counterintuitive to that, people inherently are also optimistic. So while we're afraid of losses, we're also optimistic in our outlook generally, and so that means that we do stuff that maybe, you know, will lead us to loss. And so the other big area that he focused on was the fact that because we are optimistic and because we feel we can learn lots of stuff, we believe that we can tell things about what will happen, and we believe that we can learn from looking at the past, and that if we look at and, you know, that's saying hindsight is 20/20 vision. If I look back at something and I can see what happened, I believe that I can identify why that happened. And if that's different to what I would have expected might happen, I believe, you know, that I will learn from that, and therefore in the future I'll be more informed and be. He would have said was actually what you should be learning is that you were actually surprised in the first place, because the world is surprising, and so you should be learning that there are lots more surprises out there than you expect. There's a higher level of randomness out there in the world, which you would have called noise, or the academics would call noise, than we appreciate. I suppose what that means, and the reason that I'm bringing this up, I suppose, is because I think both individually, I suppose, and as professionals whose clients look to us for advice and guidance on different things, we need to be aware of, you know, of biases in ourselves and biases in our clients, because, you know, bias in ourselves means that we need to be, you know, we need to build that into the way in which we form our views and expectations. And the biases in our clients means that we need to frame the way in which we give advice and help people do what they're doing in the knowledge of the way they will react.
So if I understand this, just so I try and just process this. If you're taking from the point of view, say, a gambler, the gambler will try to avoid those things he did in the past that made losses, and the particular types of bets he plays that make losses. He, at the same time, be optimistic. He thinks he's going to win again. And third, because he doesn't recognize all the noise, he thinks he's a better gambler than he is. So you were also telling me about the ideal advisor to the person who should be advising you in circumstances, and what decisions that you should take to avoid being that gambler.
And so there was a few things. So Kahneman was giving a presentation to the CFA a few years ago, and he narrowed down, I suppose, the few nuggets that he would say, you know, how do we conduct ourselves in a world that is full of randomness and optimistic people and loss averse people. And he said, when you're trying to advise people or make decisions yourself, you know, what you first need to do is don't trust the person in you, more lean on algorithms or processes. So almost, if you're trying to build a decision-making process, build a process that is a bit like a computer would build it. So from rational thought process, build, this is what I'm trying to achieve. This is how I might try to achieve it based on these beliefs. And so building a process gives you a framework and a discipline which helps you keep away from your own emotional reactions. That's what you're feeling right now, and helps you stay away from some mistakes. Because when you're taking decisions, a bit like you're saying with that gambler tossing a coin, take the broad view. So rather than look at what do I expect the next coin toss outcome of the next coin toss to be, say, well, actually, there are going to be 1,000 coin tosses. What do I actually expect the average, the ultimate or cumulative outcome to be? So make sure that you know the context in which you're taking decisions, and look at the decisions in the bigger picture, because that leads you to a better likelihood of getting the right answer. And so the other thing is, and which also helps with that, is regret is or loss aversion, as we talked about, is he said the biggest obstacle to effective decision making. So if you can get a sense of before you make decisions, and if you're acting as an advisor before a client makes a decision, make sure that they're aware of the range of possible outcomes rather than the probable outcome. So you don't make the decision based on the probable outcome. You think about the probable outcome, but make sure you're aware of the range of probable outcomes. And so from my experience as an advisor, what you're trying to say is, I'm saying that if we're in building an investment strategy and you have an allocation of equities, you should be fully aware that in some periods, equities will fall by 20 to 40%. And if we're not able to deal with that, then maybe this isn't the right time for us to be in equities, because nobody knows when the future is going to be, and no one can predict that with any certainty. So you need to build a framework based on probable outcomes, but awareness of the range of outcomes, and have a disciplined framework to try and keep you. The final thing that he said was when someone asked him what the secret to happiness was, he said it was quite simple. As you go through life, if you have a problem, make sure you ask for advice. Never make a big decision without asking for advice. But the person you ask advice from is very important. So you need to make sure that the person you ask for advice from is somebody that you trust to have your best interests at heart. So someone who likes you, but actually doesn't care about your feelings, because you don't want them to not give you the right advice based on what might happen. You want them to give the advice to you based on what the range of probable outcomes are, and then that's how you, they won't advise you based on your loss aversion. They will advise you based on where you need to get to, and the best sensible way of getting there. So lessons in life for all of us.
Absolutely, yes, indeed. I was hoping you'd because we've spoken about that last piece before, and I love that piece of advice about the ideal advisor. So yeah, that's absolutely. There's a lesson there for anybody involved in any sort of decision, financial, life, investment, you name it. There's some very good lessons there. Damian, as always, it's great to hear from you. And we look forward to hearing from you again. Some things to think about. I know that some of the matters we're discussing there have got legs, God knows, and we'll be asking you back again to give us an update on those the next time that we're meeting on Practice News. So thank you very much. Thank you, Damian.
No problem. Thanks a million. Anyone has any questions, make sure to reach out. Thanks a million.
Don't worry.
Well, thanks to both Conal and Damian. Fair to say, a very wide and varied session there. I love those insights, as well as, say, even good tips for life there towards the end by Damian. Now, as Conal mentioned, so much in that session. And if you have any questions, investment-wise, or for you or for your clients, of course, Damian would be delighted to have a chat with you. You have on our PDF slides there, which I won't put up now for the moment, but you have a link to Damian's email address there. And of course, he'll be back on again in our next webinar in June. But please don't be shy. If you do have investment questions, please do contact Damian. And just to thank Damian and Conal for taking the time to record that session. Now, onwards again, and bang on a few minutes behind, but not too bad on my side for my timekeeping. I'm delighted to be joined by Lillian and by Fallon Judge of the CEA. Lillian, I'm going to have a quick little chat with you first, I think, and then we're over to Fallon. And I think, Fallon, you're going to be sharing your slides, so I'm giving you a job to in the background to be getting ready to share there and so on, and give you both an introduction. Well, Lillian, as I mentioned earlier, is a colleague of mine in Chartered Accountants Ireland, and she is a solicitor by qualification, has worked as a technical accounting manager in the Institute, but has a whole, I suppose, wide variety of regulatory experience over the years. So, Lillian, great to talk with you, and I think you're going to more at the end of Fallon's presentation. You're going to have a bit more detail for us on maybe the aspects of the new companies bill scheme that Fallon hasn't touched upon. You're going to give us an overview at the end. Is that right?
Yeah, that's right. Thanks, Jeremy. Great to be here. Great to be on. And I'll go through a couple of other points other than what Fallon doesn't touch on. So yeah, great.
Brilliant. We'll talk to you then in about 20 minutes, 25 minutes. So, Fallon, great to have you with us this morning, and thank you for taking the time to join us. For those of you who missed my introduction earlier this morning, Fallon is the Director of Civil Enforcement with the Corporate Enforcement Authority, formerly the ODCE. Fallon, I understand you've worked with the ODCE cum CA for the last 6 years or so, but like many of us on here today, you're a fellow accountant and have a good deal of experience working in medium-sized practice and insolvency, receiverships and so on as well.
Thanks, Jeremy and Lillian, for me on. So as I was saying, I initially trained in a small practice in Kildare. I trained in audit and tax before I moved into insolvency. I then moved into a slightly larger practice in Dublin City, and before joining KPMG, where I worked again in insolvency and liquidations and receiverships. I then joined Smith & Williamson at the time. They're now Evelyn Partners. As in their insolvency department. So I worked primarily on liquidations and receiverships and some business reviews and restructuring projects. I then joined what was then the ODCE as a forensic accountant, and I remain here to this day.
Well, thanks for that overview of your career. It's fair to say you definitely have a great, I think, understanding of the work life and the plight sometimes, I suppose, of the small and mid-sized accountancy practitioner. And hopefully, I'm sure you bring that to bear in your role as well in dealing probably every week and every day with accountants and with their clients. Well, listen, I'm really looking forward to this presentation. So I'm going to shut up and I'm going to hand over to you, and I'll be back again in 20-25 minutes. So Fallon, the stage is yours.
Perfect. Thanks, Jeremy. So today I'm going to be giving you some insight into the work of the CEA. I'm going to run through its statutory functions. I'm going to take you through our investigative capabilities, the various sources of work, and also our approach to enforcement. I'm also going to highlight some what I believe are useful information notes that kind of help you or your clients. And I'll also touch on some upcoming developments. And finally, I will kind of outline what the CEA expects from yourselves as professionals and what you can expect from us in our dealings. So the purpose of company law is not to prevent, to ensure against, or to punish failure. Its primary purpose is to facilitate continuity and encourage entrepreneurial activity. It does so providing for separate legal personality and limited liability, and thereby circumscribing personal exposure to financial risk. However, in return for these privileges, company law sets down a framework within which company directors are expected to operate. Certain transparency requirements must be complied with, and certain protections are afforded to shareholders, creditors, and the wider public. And sanctions, both civil and criminal, are provided for in respect of certain non-compliance. So with this in mind, the CEA's mission is to promote and serve the public interest by ensuring high levels of compliance with company law through effective advocacy and proportionate, robust, and dissuasive enforcement. So what does this mean? In its simplest terms, the CEA's role is to encourage compliance with company law and to take appropriate enforcement action in response to any non-compliance. By doing so, the work of the CEA contributes towards public protection and to Ireland being regarded as a safe and well-regulated economy within which to invest and create employment. So the CEA's mandate derives principally from the 2014 Companies Acts. Its statutory functions include encouraging compliance with company law, investigating instances of suspected breaches of company law, and taking appropriate enforcement action in response to identified breaches, supervising activities of liquidators of insolvent companies, and operating a regime of restriction and disqualification undertakings in respect of directors of insolvent companies. The CEA's current statement of strategy details the approach being adopted by the CEA to discharge its functions in pursuit of its mission and vision. The strategy was informed by several key considerations, including, as I mentioned previously, that the purpose of company law is not to prevent or to punish failure. It does, however, demand that in return for the privilege of limited liability, those availing of it act in good faith and abide by certain minimum requirements of governance, transparency, and commercial probity. So the CEA's strategy comprises of 3 strategic pillars. Pillar 1 is embedding governance structures, building operational capability, and establishing presence. So this pillar focuses on the CEA itself. As a state agency, the CEA is subject to the provisions of the Code of Practice for Governance of State Bodies, which requires the CEA to implement certain governance structures and measures, including the establishment of an audit committee and putting in place necessary procedures to meet the organisation's internal audit obligations. In addition to publishing a customer charter, the CEA has established dedicated pathways for external stakeholders to engage with it. Pillar 2 is effective advocacy and influencing. So this is the outreach pillar. As companies are governed and managed by individuals, in the event of non-compliance, it is important that individuals can be held accountable. Through our advocacy program, we want to empower company directors, members, creditors, by providing accessible information on their duties, their obligations, and their rights. This is achieved through presentations such as today, targeting both directors and their advisors, and information booklets and information notes that we publish on our website. Representatives from the CEA also participate in various policy and law reform forums, including the Company Law Review Group, the Advisory Council Against Economic Crime and Corruption, and the Anti-Money Laundering Steering Group. And lastly, Pillar 3. This is the enforcement pillar. So in confronting unlawful and irresponsible behaviour under company law, the CEA will always take a graduated approach towards enforcement, as I'll touch on a little later. So our investigative capabilities. There are 8 directorates within the CEA that work together to fulfil its mandate. So these include governance and support operations, finance and ICT, legal and policy, digital investigations and analytics, civil enforcement, criminal enforcement, and insolvency supervision. The latter 3 will be more what your members will be dealing with. So these directorates comprise of multidisciplinary teams, including forensic accountants, solicitors and barristers, digital forensic specialists, and members of An Garda Síochána. The staffing complement within the CEA has increased significantly over the past 12 months, both in terms of its civilian staff and its seconded staff from An Garda Síochána. We currently have 6 forensic accountants, soon to be 7, and their main objective is to explain complex accounting matters in a simplified manner, producing reports that can be understood by non-accountants. They provide support to the Civil Enforcement Directorate, the Criminal Enforcement Directorate, and the Directorate of Insolvency Supervision. So the accountants will be asked to give their opinion on Section 682 reports received in from liquidators, and they'll be asked to explain in layman terms the impact of financial transactions that led to the liquidation of a company, or to give their opinion as to whether a particular transaction may have been undertaken to disadvantage the body of creditors. All indictable reports received from statutory auditors are considered by an accountant, who will provide their opinion as to the seriousness of the matter reported with regard to both the impact on the company and third parties. The accountants also review financial documents, they analyse complex financial transactions, and they assist with preparations of questions for the interview of suspects or witnesses by An Garda Síochána. The accountants in here are required to look beyond the numbers and to utilise their investigative skills to assist with building a narrative. In criminal investigations, typically their report will form part of the Garda case file sent up to the DPP for direction. The CEA's accountants come from a variety of backgrounds, and between them have specialist knowledge to consider not just areas of accounting, but also tax, money laundering, banking, etc. The CEA also has a team of highly experienced digital forensic specialists with access to an in-house digital forensics lab that is kitted out with various investigation software. The team can image servers, phones, or laptops, and they can make the information available to the investigation team while preserving the integrity of the evidence taken up. They utilise specialist investigative software that enables them to sort and catalogue high volumes of data in an efficient and effective manner, identifying relevant material quickly. The forensics team undergo continuous training to ensure that the CEA has the technical ability to investigate corporate fraud, and they are up to date with best practices for obtaining and securing digital evidence. The CEA also currently has 16 staff seconded from An Garda Síochána, including 3 detective sergeants and an inspector. All criminal investigations within the CEA are Garda-led. And while seconded to the CEA, all AGS staff continue to exercise all the powers conferred upon them under the various criminal justice acts. And this has an enormous benefit when progressing CEA investigations. So the CEA possesses a range of statutory powers that are granted to it under legislation to carry out its functions effectively. So certain authorised officers can evoke these statutory powers using what's called their instruments of delegation. So these powers include demanding the production of company records or information from a company or its advisors. So for example, where we have received a complaint that a company failed to hold its AGM, we can issue a demand to the company seeking a copy of the minutes of that AGM that should have been held. Where we have received an indictable report that a company inadvertently recorded a transaction in the wrong accounting period, we might demand minutes from the directors' meeting to ascertain when exactly the transaction occurred. We might also demand information from the auditor to see what was recorded in their working papers about the transaction. CEA officers do not issue statutory demands lightly, as failure to comply with a demand can have far-reaching consequences for a company, its directors, or even its advisors. So receipt of a statutory demand should be taken seriously, and professional advice should be sought where you or your client are unable to comply with them. To exercise other powers, such as appointing an inspector or exercising a warrant, the authorised officer must apply to the court and provide reasons for wanting to exercise this power. And finally, as I mentioned previously, members of An Garda Síochána can exercise all the powers conferred on them by the various criminal justice acts. So on application to the court and subject to meeting certain criteria, they can use their powers to take up company records, such as bank statements from a bank. They can arrest a suspect for questioning, and they can exercise search warrants to take up company records. So moving on to sources of our work. So the CRO has more than 288,000 companies on its register at the moment. About 95% of them are micro or small, 3% are medium, and the remaining 2% are large companies. Most companies in Ireland are complying with their obligations under the Acts. In 2023, ignoring liquidators' reports for the moment, the CEA received about 580 reports in relation to Irish companies or their directors from a variety of sources. We also receive reports from other regulatory bodies, including the Charities Regulator, the Central Bank, the CRO, and other parts of An Garda Síochána. These reports are typically submitted using various statutory gateways that allow for the transmission of material in certain circumstances. We can also open investigations on our own initiative if we believe it is in public interest to do so. This can start with something as simple as a member of the team reading an article in a newspaper. And from time to time, we'll also focus on particular sectors, and we'll get our digital forensics team to run initial checks to flag companies that may require our attention. So in 2023, we received over 300 complaints from members of the public, or interest groups or public representatives on their behalf. As you'll see from this slide, including the complaints received for allegations that company did not hold their AGMs, companies filed false documents with the CRO, allegations of fraudulent or reckless trading, or allegations that directors were not complying with their obligations. We would have investigated each and every complaint that would have came in relation to those matters. We also receive complaints, though, about matters that are not for us to investigate. So, for example, where there's a shareholder dispute or a debt dispute, these are not matters that the CEA will become involved in. And also to note, the introduction of the Protected Disclosure Amendment Act 2022, which broadened the definition of the term worker, has resulted in an increase in the number of complaints received by way of protected disclosure. It's possibly slightly more relevant to yourselves. In 2023, the CEA received 171 reports from auditors. These reports were in respect of a range of matters, including breaches of directors' loans, incorrect applications of accounting standards, or improper books of account. So, under Section 393, statutory auditors have a reporting obligation to the CEA. So, where in the course of carrying out an audit of financial statements, information comes into their possession of a statutory auditor that leads them to form the opinion that there are reasonable grounds for believing that a Category 1 or Category 3 offence may have been committed by the company or an officer or an agent. The auditor is required to provide the CEA with the particulars of the grounds on which they formed their opinion, and the auditor is expected to provide sufficient information in support of their opinion to enable the CEA to properly evaluate the circumstances that gave rise to that opinion. Where insufficient information is provided, the CEA can seek further information from the auditor, and this is typically done by way of a statutory demand, whereby you'll be given 21 days to respond to our request. The CEA will only ever seek information that is actually in your possession or should be in your possession as company auditor, such as working papers relating to the matters reported. Auditors are not expected to seek out offences, but rather to be alert and to react should information come into their possession. And offences that an auditor may identify include failure to keep adequate books and records, financial statements that did not give a true and fair view, as I mentioned earlier, loans to directors or connected persons, or financial assistance for the acquisition of shares. It should be noted that there is no time period specified, so the reporting obligation can arise where the offence occurred prior to your appointment as auditor. And one significant contributory factor that we have noted is a change of auditor. So it's not unusual for a new auditor to take a different interpretation of an accounting treatment to their predecessor, and arising from that to take the view that a submission of a report is necessary. And remember, it's not for the auditor to evaluate the seriousness or otherwise of the offence, the financial impact on any party, or whether the offence has been rectified. And issuing an unqualified audit opinion does not mean that your reporting obligation does not arise. IASA issued a guidance document back in 2019, which covers the duty of auditors to report to the Director of Corporate Enforcement. This would be a useful starting point for anyone that is unclear on their reporting obligation. As you'll see from the slide here, the majority of the reports that we're receiving at the moment are coming from Big Four firms, and it is something that we are conscious of. Moving on, SCARP reports. So this is a small company administration rescue process, which was introduced in December 2021. The purpose of which was to provide quicker and more affordable formal restructuring processes to small and micro businesses in Ireland. So SCARP allows businesses to restructure their debts by agreeing a rescue plan with its creditors, where a proportion of the debt is written off, allowing the company to continue trading. SCARP processes are ran by process advisors who have an obligation to develop a rescue plan for the company. And once the process advisor has developed the plan, they must submit their final report to the CEA. Unlike auditors, indictable offence reports, which by their nature identify potential offences, process advisors' reports are submitted to the CEA for information. Each report is considered by a CEA case officer, and in the event that a report identifies potential wrongdoing or other issues, the CEA can investigate it as is considered necessary or appropriate. Up until December 2023, the CEA had received notification of 51 SCARPs. 65 of those resulted in a rescue plan, while a further 21% of cases no rescue plan was achieved. The remainder were ongoing at the end of December. Where no rescue plan was achieved, in 73% of cases, it's the same firm have taken the appointment as the liquidator. Some other trends that we have noticed emerging from the SCARP reports that we're looking at, unsecured creditors are typically getting between 3 to 5%. Process advisor costs are typically ranging from 10 to 70,000. There was one exception outside of that. 25% of cases where a rescue plan was achieved involved a change of management. In 29 of the 33 cases where the plan was implemented, new funding was also introduced. And in 6 instances, cost reductions, including redundancies, were introduced. Reasons where no rescue plan was implemented included where no external investment could be sourced, or the directors disagreed with the conditions for external investment, or the creditor threshold for voting in favour was not met. Liquidators have 2 reporting obligations to the CEA. So under Section 683 of the Companies Acts, liquidators of an insolvent company is required to apply for the restriction of a company director unless relieved from doing so by the CEA. To assist the CEA in determining whether relief should be granted, the liquidator is required to submit a Section 682 report to the CEA outlining their findings in respect of the reasons for the failure of the company and the conduct of the directors in the period leading up to the liquidation. Relief is typically granted where the liquidator has concluded that the directors have acted honestly and responsibly in their dealings with the company and has provided the CEA with sufficient information to agree with that determination. Liquidators are required to file their first report within 6 months, with further reports at 6 months intervals until such time as the investigation into the affairs is complete. The CEA may seek further information where information provided is either unclear or insufficient. By the end of 2023, the number of companies entering insolvent liquidation had reached pre-pandemic levels. A number of factors have contributed to this, including the gradual wind down of government supports, the impact of increased energy prices, and rising interest rates. Around 800 Section 682 reports were received by the CEA during 2023. 550 of these were first reports, with a further 250 being second or subsequent reports. Where a decision is made not to grant relief in certain circumstances, the CEA will issue a restriction, what's called a restriction undertaking. The undertaking will outline the reasons why the individual is being restricted and will allow the director the opportunity to save the costs and stress of going to court. So some points for those taking appointments to note. The prescribed format of the Section 682 report was amended with effect from the 1st of October. The CEA is not accepting any reports in the older format. They'll be returned to yourself. And for the avoidance of any doubt, appending a report that was not produced for the purpose, was produced for another purpose to a Section 682 report is not considered complying with your obligations. The CEA also corresponded with all liquidators during 2023, reminding them of their filing obligations and the consequences for non-compliance. In late 2023, the CEA issued a Section 797 demand to a liquidator that failed to comply with that reporting obligation. When the demand was not complied with, the CEA commenced taking its application to the court. The matter was ultimately struck out as the liquidator complied and provided his report. However, they did have to discharge the CEA's legal costs. And this is something that's going to continue into 2024. So separate to your reporting obligations under Section 683, liquidators are required to report under Section 723 to the CEA and to the DPP if during the course of the liquidation it appears to the liquidator that a company, its officers or members may be guilty of an offence in relation to the company. And as with liquidators, receivers are also required to report where they believe the company or an officer is guilty of an offence. So moving on, while the terms enforcement and regulation tend to be used interchangeably, they're not the same thing. Regulation is proactive and typically involves standard setting, approvals or authorizations, and setting conditions of operations, supervision and discipline. For example, IASA is a regulator and they set the standards within which auditors are required to comply with when conducting audits. The central bank authorizes entities to engage in regulated activities and they attach conditions to approve firms' authorizations and they conduct routine on-site supervisory inspections. Enforcement, by contrast, is reactive in nature. It reacts to indications of non-compliance. So, for example, the revenue commissioners do not prescribe tax law, rather they enforce it. Similarly, the CEA does not set down the rules within which companies and their directors are required to comply. We just enforce the rules. But as I mentioned previously, the CEA always takes a graduated approach towards enforcement. And our enforcement work takes three forms: administrative, civil enforcement, and criminal enforcement. So the administrative measures, the CEA will seek to resolve matters of non-compliance without recourse to formal enforcement measures at a starting point. Where it is appropriate, we will engage with company directors and other interest parties with a view to securing voluntary rectification or remediation of instances of non-compliance. This approach maximizes efficiencies in that it frees up resources for deploying on examining other more serious indications of non-compliance. In instances of director loan infringements, for example, the CEA may engage with the company to secure the repayment or reduction of the loan. Such rectifications, in addition to holding up the integrity of company law, are in the interest of the affected company's members and creditors. Undischarged bankrupts are not permitted to act as company directors. In many instances, they are aware of their automatic disqualification. Depending on the exact circumstances, the CEA will engage with such individuals to allow them the opportunity to regularize their position before taking any further enforcement action. Civil enforcement Enforcement of the civil variety can include issuing directions requiring companies and their directors to comply with their obligations under company law. For example, where the CEA is notified that a company has failed to convene an AGM under Section 175. And it also includes making applications to the High Court for compliance orders. The CEA may offer restriction and disqualification undertakings to directors of insolvent companies, thus saving the director the costs and stress of going to court. And finally, criminal enforcement. On completion of a criminal investigation, the CEA can prosecute summarily in its own name in the district court, or for more serious matters, submit a file to the Office of the Director of Public Prosecution for consideration as to whether charges should be directed on indictment. The CEA website contains a lot of impartial and accessible guidance documents and information notes that may be of use to you or your clients. And I've listed some of the information notes here. In particular, I draw your attention to the last one, which is guidance regarding disqualification under company law. And this is a very recent information note, and you should bring it to the attention of any of your clients where there is potential that their companies are going to be struck off while the company is insolvent or has debt. So I don't know how I'm doing on time, but future developments. So on the 15th of March, the general scheme of the company's corporate governance and enforcement of regulatory provisions bill 2054 was published. The measures being proposed will allow companies to hold meetings either wholly or partially virtually. It'll allow for greater transparency in relation to receivers' fees. It seeks to clarify that liquidators' obligations extend to defending any appeals against restriction orders imposed by the High Court. And this is an important protection measure in ensuring that directors' accountability for their stewardship of companies. It also seeks to streamline the court process for dealing with claims of legal and professional privilege, and it seeks to expand the statutory gateway for sharing information across investigative and regulatory agencies. And if enacted as proposed, the measures will further enhance the CEA's capacity to investigate suspected breaches of company law. The bill proposes the conferral of new powers of investigation in the areas of information and evidence gathering, including new surveillance powers, which would permit certain authority officers to monitor, observe, listen to, or make recordings of persons or movements, activities, or communications in the context of a company directors or staff meetings or discussing criminal activities, etc. This would serve to provide either direct or circumstantial evidence, or in given circumstances, prevent the possible destruction of evidence. Finally, proposals look to create two new criminal offences relating to interactions with CEA officers. The first proposal is to make it an offence to obstruct or impede an officer of the CEA, while the second would result in anyone who threatens, intimidates, or menaces a CEA officer or member of their families. And these offences will be punishable by up to 10 years imprisonment if convicted on indictment. So finally, expectations. So what does the CEA expect when engaging with accounting professionals such as yourselves? You're all professionals, whether you're acting in the role of auditor, liquidator, receiver, or examiner. And we expect that regardless of your role, you are aware of your obligations under the Companies Acts, and more particularly your reporting obligations to the CEA. We'd expect you to fully appreciate when your reporting obligations kick in and ensure that reports submitted comply with the requirements under the Act. As I mentioned previously, as statutory auditors, you're not expected to seek out offences, but just be alert and react should information come into your possession. As liquidators, we expect that you comply with your obligations to fully investigate the reasons for the failure of the company and to satisfy yourself as to whether the directors have acted honestly and responsibly. While my talk today is aimed primarily at accounting professionals, if any of you are company directors, it is also expected that you're aware of your statutory obligations as directors. Transparency. We expect that professionals that are asked by their clients to engage with the CEA will do so in good faith, and we expect to receive reports in a timely manner, particularly in the case of liquidations. While it is appreciated that quite often the cases are complex and significant time is taken up with securing assets and engaging with employees at the start of a liquidation, we expect to receive reports on time and containing sufficient information. It is also expected that time is taken to ensure that any figures provided are accurate and agree to financial statements or other documents provided. and where additional information is requested, we expect a response within the timeframe outlined. And if for some reason the timeline cannot be complied with, we expect to be notified in advance of the deadline and not on or after the deadline. And it is expected that you are aware that where a statutory demand has been issued to obtain information, that you must be complied with within the given time frame. And in the event that you do not comply with a statutory demand, the CEA will take any and all enforcement action necessary, up to and including criminal prosecution. Equally, what can you expect from the CEA? The level of engagement does depend on the matter reported to the CEA. So where it is possible, we will endeavour to engage with you or your client to regularise their position and to get them back in compliance. However, we are bound by certain confidentiality obligations within the CEA. As I mentioned previously, the CEA operates a graduated approach towards enforcement. If it is appropriate to adopt administrative measures to rectify the non-compliance, we will do so. And this is typically the approach used when dealing with the less serious Category 3 or Category 4 offences. When we are considering the most appropriate course of action, we will take into consideration the seriousness of the offence, but also its potential for wider implications if the same action was to be repeated by a number of parties. And we'll also consider what actions the company has taken to prevent the issue from reoccurring. And that is all I have, so I'll hand it back to yourselves.
Thank you, Fallon.
I'll stop sharing.
You can stop sharing. Yes, indeed. Yep. Thank you, Fallon. That was a very detailed presentation. Great to get that overview of your current work, and also I think a very timely reminder for everyone. Yeah, particularly on reporting responsibilities. I suppose the accountancy sector, and especially S&P sector and the SME sector, it's the backbone of the Irish economy. So it's, as you said, such a large proportion of the companies on the CRO register as well. So great for everyone here today to get that actual that overview and so on. I actually shared your slides as well in a PDF format in the chat function. There was a few people looking for them, so hopefully you've been able to download them there as well, and we will send them out afterwards as well in a PDF. It's great to have those. And one thing I will say as well is your new, well, not so new anymore, but your CEA website. There's so many good guides up there. You mentioned a few of them there, as I say to you, from what the guide for being an auditor, the guide for company directors, liquidators, creditors. There's a lot of good information there. So don't forget, some of it has been around a while, but you may have previous versions of this from the ODC times, but a lot of new stuff as well. So it's great. We've had one or two questions there, and I think you probably covered off most of it there, as I say to you. Somebody's just asking if there was a prior year adjustment required in a set of financial statements. It could be that, as you said, they're the new accountant, new auditor in particular. What points should they consider in whether that's something they should report as well to the CEA, as well as undertaking the prior year adjustment? I think you've some of that covered off there, but Fallon, any particular thoughts on that?
Generally, where you're required to restate your financial statements,
yeah.
There's an obligation to let us know. Would be the rule I'd follow. The thing is, if you send in an indictment report, we will consider it. It could have been something very minor. It could have been a misinterpretation of the act. It could have been a new standard came out and the company missed it. And we will take all that into consideration when we look at the indictment report. What I would say to your members, if you restate the financial statements, send us in an indictment report.
That makes sense, as I say to you there. I know, Fallon, that you and the CEA team are I suppose doing a number of presentations with ourselves, with other bodies as well. You're quite active, as you said, out on the scene, just getting the word out on your work, but also on responsibilities to advisors and to directors. I know that if there was any particular questions, I think you've included your contact details there as well, links to the website and so on in that set of slides. And I'm sure that I'm sure you're a busy person and so on, but you do welcome interaction as well, and you'll try to get back to anybody who does have any particular questions. Would that be fair to say?
If anyone has any questions, fire them on to me, and if I can answer them, I'll come back to them, and if I can't, I will consult the greater legal minds in here and get them an answer. The other thing I would say, the CEA has started producing a quarterly newsletter where we do highlight any particular developments. So if a new information note has been released by ourselves, or there has been a particular change that we think people should know about, it will be picked up in our newsletter. So if people are interested, if they go onto our website, they can subscribe to our newsletter there.
Brilliant. No, that's a good point as well. I am going to, hopefully you can stay with us for another little while, even in the background there, Fallon, if any more questions come in. We're going to have just a few more updates now from Lillian with relation to, thank you for being so patient, Lillian, sitting in the background there.
No worries.
The other aspects that have come, I know Fallon mentioned a good few things there that impact the CEA in that new company scheme bill, the extra powers, the different things in that future development section. Hopefully you can see my slides there, Lillian. I'm going to click onto your bit there. Can you see that?
Yeah, it's clicking on now, Jeremy. Yeah, thanks. And just
will
to say,
click on again to the next one?
Yeah, you can click on to the next one. Yeah, just to say thanks very much, Fallon. That was very informative, and just a couple of things to say that thanks for the clarification on the scarf. I hadn't realised that there was myself that there was an FYI obligation to notify. So that was very interesting to get that CEA aspect to the scarf, and also just to mention, yes, your information notes. I had to look at your most recent one on disqualification of directors, and the interesting cases referred to there. There was one in 2022 which showed the significant engagement of the director with the director of corporate enforcement, that is, with the directors before they would give the relief from the disqualification. So there's lots of good stuff in there, and then the difference between the corporate, the civil, and the criminal, and the amount of engagement that you have before, depending on the case, before you would before it would get more serious. Just I just had a couple of things to cover out on the new heads of bill. So the first one there is the proposed amendments. So these are proposals, and as I said, Fallon has covered a good few of them. So I just kind of focused on ones that might be interested to our members as well. Amendment to the loss of the audit exemption. So the current position is that the small company loses the audit exemption following one failure to file, and it's proposed that it'll only be lost following a second failure to file within 5 consecutive years. In both cases, in the current and the proposed, it will be lost for 2 years, and there's still late filing fees. So well, hopefully that was one that I think that the Institute has been campaigning for some time. So hopefully that will come into to force. Fallon mentioned the provisions regarding receivers, and just to say that they look for further information on the E8 file and receiver's appointment. Some time limits proposed to change there on filing receiver abstract and cessation of receivers, that they're reduced or introduced as 7 days. And then, as Fallon mentioned, the new provisions for remuneration of receivers, and they largely align with provisions in the Companies Act regarding liquidators. So that's that one. Then there's 3 new grounds for strike-off: failure to notify of change, proposed for strike-off, failure to notify of change of registered office, no current company secretary recorded in the company's registration office, and failure to deliver beneficial ownership information. Then the electronic meetings, that is proposed to put them on a permanent statutory basis, and the current temporary provisions are there until the 31st of December this year. Fallon's covered the Corporate Enforcement Authority provisions, and you have your information note as well, and all that, which goes into that in a good bit of detail as well. And then just mention the last one there, provisions relating to IASA. There's a proposed new power to issue an interim notice of restriction of a statutory auditor on possible contravention. And they've given examples in the heads of contraventions, which are not exhaustive, but include failure to obtain sufficient evidence to support an issued audit opinion, a repeated significant deficiency in standards of audit work, or significant breaches of independence or ethics rules. So, as I said, I've given in the slides, which will be available, I've actually linked to the scheme, the heads itself, which is quite you can have a look through it there. And we did a note recently, a news note on items that might be of interest to our members. And then there's the CEA publication. So it's the links to all of those there as well on those slides. And then, Jeremy, just to mention, sorry, I mentioned it earlier, but there may not have been everybody on at the time, that my colleagues and professional accounting team are running a free webinar on SCARP on the 29th of May with Hilary Larkin and David Swinburne of Mazars. So we'll give you the link to that when it's available for passing on. And yes, Laura, my colleague Laura Michelle has produced the Economic Crime and Corporate Transparency Act 2023. Is UK legislation, came in, was enacted last year, and it's going to be rolled. It's a voluminous and comprehensive piece of legislation. It's going to be rolled out, I think, over the next while. So We've done a couple of notes. Laura Michelle did a note there on the changes that came about on the 4th of March 2024. Some changes were introduced, so that's in that information booklet there. So I think that is everything that from my side, Jeremy. So
thanks, Lillian. You had a lot to fit in there to a few minutes. Very good summary. And yeah, so much in that new scheme of the companies bill. I imagine when it gets to legislation, there'll be a few tweaks, but I think most of the stuff will come through, and it is a timely, after 10 years, update to the companies bill. Indeed, from the UK point of view, we will keep in the Institute putting out guidance as the Economic Crime and Corporate Transparency Act it gets implemented. Yes, some changes coming in there around company addresses, different things from the 4th of March. Be aware that particularly if you're in the Republic of Ireland, and maybe I have only a couple of clients in the UK, but of course if you're in the UK as well, and that's there for you at the link on those slides, and you can download those slides from the chat function earlier as well. Fallon and Lillian, thank you very much for that very comprehensive presentations. Hopefully you can stay on with us for a few more minutes. We're into the homeward stretch, guys. A little bit behind, so my apologies timing wise. We will have a presentation now on UK taxes by Leontia Doran, our UK tax lead. I know we had some questions that have come in there as well over the last hour or so with relation to Gearóid's presentation on tax, and one or two came in from people with relation to somebody had an AML query, an anti-money laundering query. I'll start with that one, the anti-money laundering query. I don't have a name for the person on it there. They're down as anonymous on this thing. So if you do have a specific query you'd like to talk to the practice consultant team, if you could drop us an email to practicemembers@charteredaccountants.ie, and we'd be happy to have a quick chat with you on that specific AML query. Obviously, I don't know who you are at the moment. And the same, if you have any issue that you piqued your interest from Gearóid's presentation, as I mentioned, Gearóid would be delighted to have a chat with you, and you just email him there, and his email address is on the presentation slides. So hopefully that will get you some clarity on those issues as well. So listen, Chris, how are we looking for our final presentation with Leontia? And guys, we'll be back with you in about 20 minutes.
Hello and welcome to the second UK tax update for Practice News in 2024, and specifically for the Friday the 12th of April 2024 edition. I'm Leontia Doran, the Institute's UK tax specialist, and I have nearly 30 years experience working in UK tax. In this short recording, as normal, I'll be providing you with a brief update on what's been happening since our February update, and what we as an institute have been working on for you, our members, but also what we'd like to hear your feedback on, including HMRC services and, of course, the current consultation looking at options to regulate the UK tax agent market. So let's get going. This time around, the key themes I'm going to cover are making tax digital, some of the key changes which took effect recently as a result of the beginning of the new tax year 2024-25 and the new financial year 2024, an update on recent developments in HMRC services, and finally, the consultation that I mentioned earlier on options to regulate UK tax practitioners. So let's start with making tax digital. Now, since the last update, we've had the spring budget on the 6th of March, but also HMRC have backtracked on a range of matters, including proposed permanent changes to its helplines, but also the VAT treatment of double cab pickups. However, making tax digital is still large on their agenda and in their sights, and that was very clear at the HMRC stakeholder conference in February 2024. That's despite the likelihood of a change in government this year that leaves agents and businesses uncertain if they should participate in the wider Making Tax Digital for Income Tax trial that's due to commence later this month. So first, by way of reminder, from April 2026, MTD for income tax will apply to unincorporated businesses and landlords with businesses, trading income and or property income over £50,000. So that's from April 2026 for that cohort, followed by those with income over £30,000 from April 2027. Now, following a consultation that took place between December and January, the final Making Tax Digital for Income Tax regulations have now been finalised and laid before Parliament. Just note that as part of this consultation, the Institute recommended in its consultation response that the deadline for filing quarterly MTD updates be changed from the 5th day to the 7th day 1 month after the quarter end in order to align with the VAT filing deadline. We're pleased to say that HMRC have taken this on board and have included this in the final regulations. Now note that the final regulations, alongside the earlier regulations that they amend, set out the requirements under Making Tax Digital that must be complied with, including the use of MTD compatible software to keep and preserve business records in digital format, and the sending of quarterly updates of these records to HMRC. HMRC have also published an updated notice which sets out the information that should be sent to HMRC quarterly using MTD compatible software. However, we are still awaiting detailed information on the digital links and digital record keeping requirements. Note also that, as I mentioned earlier, the trial is intended to be widened out this month. So from the 22nd of April, HMRC is aiming to widen participation in the Making Tax Digital trial. So you will start to see a range of comms from HMRC over the coming weeks, which will be encouraging agents to sign up clients that currently qualify for the trial. The Institute therefore advises members to carefully consider both the advantages and disadvantages of participation in this trial ahead of the first phase of mandation from April 2026. Now let's move on to the new tax and new financial year. So both of these began earlier this month. We're going to just briefly cover some of the key tax changes that took effect. Firstly, for accounting periods of companies that begin on or after the 1st of April 2024, the merged R&D tax relief scheme took effect, in addition to the additional relief available for loss-making R&D intensive SMEs via the 14.5% higher rate payable tax credit. From the 6th of April 2024, the reductions in the rates of both employee and self-employed national insurance contributions commenced as follows. So firstly, the main rate of Class 1 employee NICs reduced from 10% to 8%. And secondly, the NICs rates for the self-employed across the UK reduced from 9% to 6%. Also from the 6th of April 24, self-employed individuals with profits above 12,570 are no longer required to pay Class 2 national insurance contributions, but they will continue to receive access to contributory benefits. I'm also going to now set out a highlight section which covers a range of other changes. Firstly, the higher rate of capital gains tax on residential property disposals reduced from 28% to 24% from the 6th of April 2024. Also from the same date, the dividend allowance reduced to £500 from £1,000, and the capital gains tax annual exemption reduced from £6,000 to £3,000. The cash basis is now compulsory for all unincorporated businesses from the 6th of April 2024, unless they opt to use the accruals basis. And from the 6th of April 2024, the tax year basis is the basis of assessment for all unincorporated businesses as a result of basis period reform. Note also that from the 1st of April 2024, the VAT registration threshold increased from 85,000 to 90,000, and the deregistration threshold increased from 83,000 to 88,000. So moving on now to HMRC services. Some of you will be aware that last month on Tuesday the 19th of March, HMRC announced a range of permanent changes to its self-assessment, VAT and PAYE helplines. For example, it proposed that between the 8th of April and the 30th of September 2024, the self-assessment helpline would be closed, and thereafter it would only be open to deal with priority queries. The VAT helpline would only be open for the 5 days ahead of the deadline for filing VAT returns, and the PAYE helpline would no longer take calls about refunds. Instead, callers would be directed to use HMRC's online services. However, the very next day after this announcement, HMRC backtracked and announced that the changes were being halted, whilst it considers how best to help taxpayers harness online services. It got a lot of media coverage. Now, although the decision to further consider this is welcome, it's disappointing that feedback provided by this institute and other professional bodies when these changes were discussed on a confidential basis, when we raised various concerns about the proposed changes, appear to not have been fully considered before the formal announcement was made and then subsequently reversed. However, the Institute will engage with HMRC as it considers the way forward, and of course we welcome your feedback at any time on HMRC services. Turning now to the tax agent regulation consultation. Last month at the spring budget, HMRC launched this long-planned consultation called Raising Standards in the Tax Advice Market, which essentially examines 3 options to potentially strengthen the tax agent regulatory framework in the UK. Now, this consultation will close on the 29th of May 2024, and it also sets out a need perceived by HMRC to define tax practitioner legislatively and a proposal to mandate registration with HMRC for tax practitioners who want to interact with HMRC on behalf of their clients. This consultation is quite lengthy, hence we have summarised its proposals in 3 news stories on our website, which we will be summarising in one document to be published in the next few days. Now, the Institute is discussing its response to this consultation both internally with professional standards, with Council, and with other colleagues in the Institute, and with the other professional bodies as well. We also want to hear from members. Feedback is also sought from members by email to tax@charteredaccountants.ie by Tuesday, the 7th of May 2024. So, let's look briefly at the 3 potential regulation options. Option 1 looks at mandatory membership of a recognised professional body. Option 2 looks at joint HMRC and professional body, i.e. industry enforcement. And the final option presented is regulation by a separate statutory government body. So firstly, option 1, mandatory membership of a recognised professional body. This option is clearly the option which HMRC are leaning towards, but they recognise that this will depend on the capacity and willingness of the professional bodies to do so. Of course, that includes Chartered Accountants Ireland. Now, this option will involve mandatory membership of a recognised professional body, with professional bodies monitoring and enforcing the standards of their members and raising those standards where necessary. Taking forward this approach would mean tax practitioners would be required to hold membership of a professional body that is recognised as having an adequate minimum standard for its members and an adequate supervisory framework to monitor and enforce that standard. Now, HMRC and the government consider this approach to be proportionate because they say it would minimise the extra costs and burdens to tax practitioners who currently meet expected standards. And they also say that most of the professional bodies currently deliver the 3 components that they want to see in a regulation framework, which is essentially 1, subjecting their tax practitioner members to minimum standards, 2, monitoring and enforcement action, and 3, offering routes for support where standards fall below that expected. Turning now to option 2, joint HMRC and professional body, i.e. industry enforcement. So under this option, HMRC and industry would monitor and raise standards of the market together. Unaffiliated tax practitioners who weren't a member of a recognised body would be supervised by HMRC, and the professional body member would remain subject to the supervisory requirements of their professional body. Tax practitioners in scope of the framework would be required to become and remain a member of a recognised professional body or be supervised by HMRC to provide tax advice and tax services. Under this option, professional bodies' responsibilities would remain the same according to HMRC. They would not be expected to oversee the unaffiliated market. Therefore, HMRC believes that when looked at in comparison to option 1, this would also have a minimal impact on current professional body members who meet expected standards. However, under this approach, HMRC would take a greater role in maintaining and raising standards of those tax practitioners who are unaffiliated with a recognised body. And finally, option 3, regulation by a separate statutory government body. So this would see the introduction of a new independent regulator or the expansion of the remit of an existing regulator to regulate tax practitioners, and that would be all tax practitioners. HMRC believes that this would provide consistency across the market and would also avoid both potential conflicts of interest arising from HMRC acting as a regulator and a potential race to the bottom. The government regulator would be required to set standards, carry out checks on tax practitioners, which could include things like annual reviews, check tax practitioners who are seeking to be regulated, and ensure they meet the required criteria. Current professional body members could be automatically registered with the regulator, as they have already undergone a series of checks, and professional bodies could retain their role as providers of qualifications and ongoing practice support. So overall, alongside the proposals which HMRC say are required to raise standards, the government wants to improve the way that tax practitioners actually register with HMRC. They want to simplify that and improve it. So remember, we'd like to hear your feedback to tax@charteredaccountants.ie by the 7th of May 2024, and we'll provide contact details again for that later. And finally, I just want to wrap up with a couple of other matters. Firstly, I want to remind anyone in business or with clients in the second-hand car business that second-hand cars moved from Great Britain to Northern Ireland before the 1st of May 2023 will only be able to use the VAT margin scheme until the 30th of April 2024. You might remember that the Institute extensively lobbied HMRC in September and October 2023 to extend the original 31st of October deadline, and we successfully achieved a 6-month extension from 31 October 2023 to the 30th of April 2024. Now, in recent weeks, we have issued several reminders about this deadline, which means that if these vehicles are sold after the 30th of April 2024, VAT will be chargeable on the full selling price and not simply on the margin. At the request of HMRC, we recently gathered some evidence from local car dealers which demonstrates that many of them are still experiencing delays in selling these vehicles, and this is for a range of reasons, including the current economic environment and delays in MOT testing. We also met at the end of March at the request of HMRC with their VAT policy team to discuss and present the evidence gathered from local dealers. At that meeting, we also explored the potential for either removal of the cliff edge deadline, a type of amnesty, or another extension. We just want to make clear that HMRC is insistent that the deadline remains 30th of April 2024 and that there will not be a further extension. According to HMRC, this deadline is required for legal certainty, whatever that means. Now, despite presenting evidence of the ongoing difficulties being experienced in selling these vehicles, we are disappointed that HMRC is insisting that this cliff edge deadline of 30th of April 2024 remains in place. Members and businesses may therefore wish to consider how they could utilise their own contacts and networks to demonstrate their concerns to HMRC in respect of this, including the impact it will have on these businesses, the second-hand car market, and wider society. And finally, I want to remind you that this year's Tax and Maintenance Day will take place next week on Thursday, the 18th of April. This now annual fiscal event is expected to contain details of work in simplifying administration of the UK tax system, in addition to a number of awaited consultation responses. Chartered Accountants Tax News on Monday, the 22nd of April, will therefore report on the announcement made on this day in full. Just a quick reminder that this recording gives an overview only of what's been happening and our key work streams. Remember, you can keep up to date with all the latest Irish, UK and international tax developments through our tax newsletter, which issues every Monday, and you can see there is a link to subscribe to it on this slide, in addition to contact details if you need to get in touch. And finally, I want to just sign off by saying thank you very much for listening, and please do get in touch if you have any questions or want to share any feedback. Thank you.
Leontia, thank you again for a very comprehensive update. Guys, if there is, I suppose, any comments you have on that consultation that Leontia has outlined by early May on the oversight of tax advisors by the UK government going forward, I think that's a vital one. So please do share your thoughts with Leontia. That will be built in to the Institute response back to UK authorities on this. And as I say, yeah, look, thank you again, Leontia. If you do have any questions for Leontia, as she said, don't be shy. Please drop her an email. I know Leontia will try to get back to you as soon as possible, and she does value, same as Gerald as well, to have the opportunity to talk with members and learn the issues that you are facing. So that is great. Now, we're nearly there. Before we wrap up, I'll just go back to, I think it's just Lillian I've left here now. I'm thinking, oh, actually Fallon maybe here as well. I'm not sure. I didn't see any other questions coming in, but I always find after I give a presentation, one or two things pop up and I say, I should have said that, I should have said this. Lillian, Fallon, is there anything else you'd like to just put in as closing thoughts here before we wrap up in the next 30 seconds, minute or two?
No, I don't think so. Lots to think about, lots in there, Jeremy, as usual. So no, I think that's very comprehensive. Thanks very much, and thanks very much to Fallon for giving us our time here today. It was very interesting. Thanks.
Brilliant, Fallon, indeed. I'm not sure it didn't pop into your mind, as I say to you. I know we had that one or two questions and different things there, but you gave such a detailed presentation, and I know there will be certain, I suppose, issues where it'll be company-specific different things, and they'll have to contact the CEA and get talking to you on those matters.
Yeah, just to say, like, while I will be able to give general guidance, I cannot give professional advice.
Yeah.
So if there's any particular matter someone has a question on, they do need to go and get independent legal or accounting advice, rather than coming to ourselves. But that said, look, if people want to ask a question, I'm happy to receive the questions, and where I can, I will answer them.
Brilliant. No, that's a very important interpretation. I think most of the people here today will be in practice as opposed to members of the public, obviously coming to you, company directors, or actually people outside of practice. But no, that's a very good thing as well. Well, as Lillian said, Fallon, thank you for taking the time to join us. It's great to have you on the presentation here today. And also to thank all our actual contributors here today, Carol, Leontia, Lillian, of course, and also to have Damian and Conal, and I'm leaving other people out as well. I know behind the scenes, Chris has been great lining up all the recordings, so thank you, Chris, as ever. And also our team, Paul and the CPD team, Amy on communications, everybody who's helped me out in this. I'm sure I still left somebody out. Again, guys, if you do have any questions that come to mind after this, you can contact us on our practice members email address. On the slides that we have there as well, we have some details of our upcoming webinars. I mentioned some of them earlier. We have one on auditing, the 25th of April, half day. I'm sure we will be mentioning some of that stuff coming from the company's general scheme and update bill, and some of the stuff from the CEA there, financial reporting on the 8th of May. Solicitors, actually, the new Solicitors Accounts Regulations, we're delighted we're going to be joined by Rory O'Neill of the Law Society. We've had Rory in past presentations. That'll be on the 23rd of May, but it's on the slides there anyway. So if you want to learn more about those, please do click through and take a look at them. So guys, I think I've taken more than enough of your time. Hopefully you found this morning's webinar informative. As I mentioned before, we will be sending out all the slides. Hopefully most of them you've been able to download here. We'll send out all the slides again early next week with a copy and a link to the recording, and that you can go back through it again. And all the past recordings are up on our website and also our Institute YouTube channel. So if there's one thing going away here today, I would say sign up and follow YouTube channel. You get lots of free webinars from the Institute, not alone practice news, but other webinars. So it's an invaluable resource, and it's there for you as members. Guys, thank you very much for your time this morning. Hopefully you found the webinar useful. As I say, we'll also have a survey in that follow-up email as well. So please do give us your comments and feedback. We do value them as we try to push forward and do new webinars again over the coming weeks and months. Hopefully we'll see you all soon, and thanks to everyone.